In this first lesson, we'll be looking at the brokerages that we prefer to use when trading stocks: TD Ameritrade, Webull, and Robinhood. Before anything, let's just do a brief overview of the three brokerages. First, let's take a look at TD Ameritrade. Specifically, we will be looking at thinkorswim, TOS for short. TOS was created by TD Ameritrade, the number one overall recommended broker on stockbrokers.com, and offers desktop, web, and mobile capabilities. TOS offers some of the best charting tools among brokers and offers over 400 studies and 20 drawing tools, and also offers paper money. Paper money is a feature that allows newer traders to learn how to trade using fake money in a simulated market that emulates what the market is doing in real time. Both of the above features are offered on TOS mobile platform and is considered the best charting software of any mobile platform in the industry. Some of the downsides of TOS include option commissions rates, which come at around 65 cents per contract. However, there are free commissions for stocks and ETFs, and the wealth of tools may seem overwhelming for the newer trader, but it's nothing too difficult once you get the hang of it. Next, let's take a look at Webull. Webull will mostly appeal to those who prefer mobile trading over desktop, as the sleek interface draws you in with a huge selection of charting tools. It can be said Webull is the best for intermediate investors, active traders, options traders, and cryptocurrency traders. However, its lack of educational content will leave the newer traders at a disadvantage. Webull is one of the most affordable platforms to use, as there are no fees for trading, including options. Lastly, Webull offers 24/7 customer support through phone, email, and chat that are available in the mobile app. Finally, let's go over Robinhood. Robinhood will appeal to all new traders who prefer simplicity in a mobile app. Although Robinhood is lacking in the charting tool and technical aspect of brokerages, traders will find that executing orders on Robinhood is actually very easy to do. Robinhood offers commission-free trading and a Robinhood Gold membership where traders have the option to see level 2 data, get access to instant deposits, and more for a monthly fee of $5. Some of the downsides of Robinhood include the lack of technical data and charting tools, as well as educational content. And there have been numerous reviews of traders experiencing slower than usual order fill times. Because of this, Robinhood is not recommended for the active day trader and is solely recommended for those who are just starting out in their trading journey. Now that we have a strong overview of the three brokerages, let's compare them to each other and you can decide which you would like to use as your brokerage. Let's use a nice visualization like this Venn diagram here to compare the three options that we have presented for you. In each of the circles, we of course have TD Ameritrade, Webull, and Robinhood. Let's start off by assessing investor levels typically associated with each brokerage. For more casual investors, Robinhood is best suited for this as the user interface is extremely easy to navigate. It is quite simple to search an asset and trade it without having too much trouble at all, making it extremely easy for novice traders to use. As traders move toward a more intermediate level, Webull is a stronger pick for a brokerage. It is also quite possible to start trading with Webull, but keep in mind that the learning curve on the platform tends to be a little bit more difficult to use. However, with some practice, it becomes quite clear and easy to use. And for those who are looking to take trading more seriously, TD Ameritrade's thinkorswim is an excellent choice. Quite similar to Webull with a few more upsides. However, it is important to remember that those upsides come with a more intense learning curve, but once again, with some practice on the platform, it is easy to overcome this curve and be proficient with the platform. In terms of educational resources, Robinhood has quite limited resources and is not the best place to learn how to trade. Webull introduces itself as a far more research and data-oriented platform, and in most cases, most of the information that you need to make a trade will be directly on the platform itself, so you won't have to travel far to do the necessary due diligence before entering a trade. Finally, TD Ameritrade has by far the most in terms of data and research. The platform is full of webcasts, slideshows, articles, and even a chatbot that will provide you with the proper information to make strong trades. It was even ranked as the number one brokerage for education by stockbrokers.com for the past 8 consecutive years. So what type of securities can you trade on each of these platforms? Each of the three platforms allows for stocks, ETFs, and options to be traded directly on the platform. However, cryptocurrencies cannot be traded on TD Ameritrade yet, but are accessible through both Robinhood and Webull. American Depository Receipts, or ADRs, are unavailable on Webull as of now, but can be traded on both Robinhood and TD Ameritrade. Although TD Ameritrade does not currently grant access to trade cryptocurrencies, they allow for bonds, mutual funds, futures, forex, and even IPOs for qualified accounts, which is much more than currently available on both Robinhood and Webull. Each of these three platforms can allow for extended trading hours, but be cautious while trading in extended hours as volatility tends to be much higher due to less trades being placed at these times. Let's talk about fees. There are no trading fees for stocks and ETFs on all three of these platforms, but only Webull and Robinhood allow for no fees for options trading, as TD Ameritrade has a fee of 65 cents per contract. But all three of these platforms allow for no account minimum to get started with trading, allowing access to traders of all bankroll sizes. There is a bit of an incentive to trade with Robinhood or Webull, however. Both platforms give you a free stock for signing up on the platform, ranging from about $2.50 to about $250. But Webull will also give you two more free stocks for deposits of qualifying sizes. But TD Ameritrade is the only one with a physical branch. In fact, they actually have more than 175 branches across the country that host both virtual and in-person events for educating traders. For those looking to establish themselves with long-term retirement accounts, both Webull and TD Ameritrade allow for this. But Webull does not currently have dividend reinvestments, which is an attractive trait for many investors. For those with smaller accounts, you'll be able to buy fractional shares on both Robinhood and Webull, but that option is currently unavailable on TD Ameritrade. Fractional shares are especially good for those with smaller accounts that would like to own a piece of higher cost shares, such as Amazon, without having to allocate too much money for a single share of the company. Let's talk about trading on the platforms themselves. It is typically a smart idea for new traders to practice trading with fake money just to get the hang of concepts and develop strategies. This can be done through paper trading, which is offered on both TD Ameritrade and Webull. Unfortunately, Robinhood does not currently offer this ability. Also, Webull and TD Ameritrade offer great charting and screening software to assist with technical analysis, which we will delve into in further detail in the next module. But the ability to both paper trade and have access to data trading software on TD Ameritrade and Webull make them extremely suitable for active trading, which is trading based on technical analysis and determining entries based on momentum or indications of a large move. While Robinhood can be seen as a place for beginners to simply buy and sell securities without too much of a hassle. So, what do we suggest when picking a platform? If you are just looking to start your trading journey, enjoy watching the market, but don't plan on taking these too seriously, then Robinhood is likely the best choice for you. However, if you are looking to get a little more serious with your trading, then Webull or TD Ameritrade are likely to be the better options for you. Keep in mind that there is no wrong platform to use, and if anything, you can try all three of these out, and whichever gives you the best experience can be the one that you stick with. After choosing a brokerage, you'll need to make a decision between opening a cash account versus a margin account. So, what is the difference between these two types of accounts? Well, essentially, you can think of a cash account as like being a debit card, where you can spend only what you deposit, while a margin account is like a credit card, where you can borrow money from the broker to gain more leverage on positions. With a cash account, you can pretty much only lose what you put into a position, and you know your potential loss if things aren't to go the way that you would expect. Also, with cash accounts, you can only use cash that has been settled after each transaction. The time to settle tends to be about 1 to 2 days depending on the brokerage you are using. However, with the cash account, you can get around the pattern day trader (PDT) rule if you are using a smaller account to trade with. The PDT rule requires that you have $25,000 in margin account to be able to make as many day trades as you would want. However, if you have less than this, you will be restricted to 3 day trades per 5 trading days, making day trading quite difficult for smaller accounts. Yet, if you use a cash account, you can make as many day trades as you want as long as the money that you are using has already been settled. This means if you have $1,000 in a cash account, you can make a trade with $100 10 times in a single day. But after you use the cash to make a trade, you have to wait for it to settle again before you can use it, which, as we mentioned, generally takes around 1 to 2 trading days. Okay, so let's take a look at margin accounts now. The single most advantageous reason to open a margin account is because it significantly increases your purchasing power. For those with relatively small portfolio sizes, a margin account allows you to boost returns and better diversify your portfolio. Also, a margin account allows for more options in investing. As you recall from the cash account, you can only pretty much attempt to buy low and sell high. With margin accounts, you can actually bet against stocks by short selling them through borrowing shares. But what comes with using margin is a severe increase in risk. It is possible to lose more money than your initial investment when you buy on margin, as you can lose your own investment plus the money that was loaned to you to establish the position. And if you do not add funds to your portfolio after you have lost funds from the loan on a trade, the broker may liquidate some or all of your position in order to protect its loan. Also, another downside to using margin is that you'll have to pay interest on the loan as well. Most of the time, the interest rate is about 8% a year on the amount that you borrow. So keep in mind, if you do not think you'll be making back that additional 8% in profit each year, then buying with margin might be a poor decision. Both account types have their upsides and downsides, but before making a decision, make sure you fully understand the risks involved and remember, never risk more than you are willing to lose in financial markets. Anyway, that will bring a wrap to the first lesson of the Syndicate Academy. In the next lesson, we will be talking about types of security trading.